We have Taiwan index that is down almost 0.5% on trade.
4th of June low to the all-time high. That only comes in at about 23,189.
Second month in a row when the government has gone ahead, cut allocation of domestic gas to city gas distribution companies.
At 23,540, the Nifty Bank at 5220, the sensex at 77,650.
Last month again was a record month for mutual fund inflows, and I'm assuming that the other inflows continue in the insurance, EPF, NPS space.
Number of respiratory approvals, products awaiting approval. So we expect that should help us to kind of improve our margins.
IT is the big drag. It's down around 2.5%. We have Nifty Pharma again, which has come in for a bit of profit taking.
From its 52-week high, the stock is nearly half, 45% decline after a 20% fall today as well.
Air quality index in the national capital has already reached severe plus levels. It has crossed 440.
Stocks slip in a volatile start, but the market recovers from the day's low, led by metals and the auto sector. IT and energy remain the key drags.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Well, that's a day so far is looking better. We are coming to you from the CNBC-TV18 Motilal Oswal studios. Closing bell coming to you 15 minutes earlier than scheduled. I'm Prashant. With me, my colleagues Nigel and Mangalam. Guys, hi, good afternoon.
Good afternoon. 15 minutes earlier than scheduled, and the market recovery hasn't been too bad either. It's interesting that, market has recovered from the lows, but at higher levels, it is facing some sort of supply. So it's, what do you say, the recovery not as early as one would have expected, not earlier than scheduled as compared to closing bell?
Well, and I think it's heartening to see at least the mid-cap index is trading in the green, right? Mildly so, but it shows you that there is some kind of bottom fishing out there, because we talk about the index being down 10-11%, but stocks have fallen 25, 30, 35, 40%, and some of them, well, they needed to correct. But there are various good quality names as well out there that have corrected 30%. So in that case, I think there is some bottom fishing taking place.
Well, let's hope the fishing continues, and the fish.
Otherwise, they hit the bottom.
A lot of fish out there. Well, let's ask someone about the big key top of mind topics now. We have Alexander Redman, who's the chief equity strategist at CLSA, joining us on the program. Alexander is someone who's made big country weight change calls. The last big call, of course, was moving some of the allocations to China. And in a note which he's put out in the last 72 hours, he's reversed that. He's essentially saying that they've cut their overweight in China, and they're increasing their overweight in India back to its 20% level. Alexander, good to have you with us here from the sidelines of the conference. Prashant this side. The question will be, why are you sort of doing that now? But the bigger question for our audience, right, is this big phase of FII selling that we've seen, foreign selling that we've seen in India, are we at the fag end of it? So why don't you answer that question in the context of FII selling?
Right. Okay. Thank you very much for having me today. So look, the paradox here is that you've seen about $14 billion worth of foreign investor selling since the end of September. I think initially the motivation for that was to participate in the rally that you've seen in China. That initiated with the PBOC stimulus, which kicked off towards the end of September, and caught a lot of foreign investors unawares. I mean, they were sitting on relatively underexposed positions on China, and so used large liquid names in markets like India and Korea to liquidate positions and participate in the China rally. So what we've had now is about 14 billion net foreign selling since the end of September. But the paradox here, of course, is that in meetings that I've had with investors over the course of this year, this is precisely the opportunity that foreign investors have been looking for to actually build up their exposure to Indian equities, where there's been a relatively high degree of frustration that the market has continued to outperform through much of this year, and they've been nursing large underweight positions. So I see ultimately the 12% sell-off is probably sufficient to begin to encourage foreign investors to start to participate in Indian equities again.
All right. Hi, Alexander, and good to see you in. This is Nigel on this side. And that'll be music to the ears of a lot of investors here in India, because our domestic flows have been rock solid. The problem is this big FI selling. So put everything that you've said together, and given that Chinese stimulus, so to call it, has been underwhelming, do you think that bulk of that FI selling is done? And now maybe we could see a bit of a pause and maybe those flows turn into buy flows as well, since this is the opportunity that they're waiting for?
Yeah, so I reversed the tactical position that I built up in China right at the end of September, essentially for three reasons. One, because the re-election of Donald Trump obviously complicates the China trade outlook. I think we're all familiar with the potential high level of tariff implementation there. Secondly, because I found the NPC stimulus at the end of the previous week somewhat underwhelming. Myself and many foreign investors were looking for the stimulus to be more targeted at consumption, at further absorption of excess inventories in housing, and also to recapitalize banks. And the third point is that with higher bond yields globally now, I think the PBOC will struggle to cut rates further. So having been underwhelmed over the last few weeks or so with Chinese performance, I've decided to reverse that tactical allocation that I made towards China, put that money back towards India. And as I mentioned earlier, I think this is precisely the opportunity that foreign investors have been looking for to get back into this key growth market.
All right, so let's put some numbers to that thesis. You know, from the time when you first decreased your allocation towards India and increased it towards China versus now this reversal, how has the differentiation between both of them panned out? Because what I see is, you know, the up move that we've seen in Hang Seng versus the down move that we've seen in the Nifty, it's a 30% sort of delta that has taken place. That's point number one. And secondly, what are your risks to the current thesis? Because you do say that India has a moat against President-elect Trump's proposed economic and trade policies, where the fear is that maybe something comes by on electric vehicles, something comes by on the IT industry, something comes by on the pharmaceutical industry.
Right.
And the second part is urbanization. You know, that as a theme for India, that also in the last couple of quarters has been under concern, largely because of the urban slowdown itself that we're seeing in India. So in light of all of this, what are the risks to your thesis?
Yeah, I think if you are ordering emerging markets according to their sensitivity to an adverse trade policy from the United States, you need to look at a few things. I mean, one obviously is the level of tariffs, which have been suggested during the campaign. Our understanding is around 60% on China, although we don't know when that would be implemented, and around 10% on other markets. Another thing to be aware of is just the trade exposure to the US. So we're looking at things like overall proportion of GDP, which is direct gross exports to the US, the proportion of overall revenue within markets, which are foreign sales. Other things to be aware of is that with higher global bond yields, clearly you don't want a large degree of leverage. So we've looked at data across net debt to EBITDA across markets. And the other thing, as you point towards, is the foreign ownership level of India. At 17.5%, that is amongst, if not the lowest, across emerging markets. There are some other markets like Brazil, which are upwards of around 60%. So if you combine those five attributes together, ultimately what you want to be is, you know, having a low figure for each one of those. And India, on all of those measures, actually comes out as amongst the least sensitive to a negative trade environment. China, much towards the top. But the other key risk, I mean, I think India is well positioned here in an escalation of the trade war. But the other key risk that I would say is more idiosyncratic for India is just the uptick in issuance that you've seen year to date. Now, if you express this as a percentage of market cap, what you've had in the last 4 cycles is when total primary and secondary issuance has hit about 1.5% of market cap, that's when the secondary market has begun to roll over. So that's the kind of the tipping point where Indian equities typically get saturated with primary flow. The key risk at the moment is that we are approaching that same tipping point. And so I would expect the momentum of Indian equities in absolute year-on-year terms to begin to slow down in sympathy with that. But ultimately, this is a relative call, and I still think India is capable of outperforming China at this point.
Okay, that's an interesting point. You're saying cumulative 12-month equity issuance in India has hit 1.5% of market capitalization, and historically that has been a bit of a tipping point, right? I mean, equity issuance, supply swamps the market.
Yeah, so if you look at the absolute numbers, they're obviously sky high. You know, we've hit about $66 billion worth now of cumulative issuance in the last 12 months. But you do have to control for the fact that Indian market cap has gone up so much over the previous decades. And when you control for that market cap, you find that 1.5% has been the tipping point in the last 4 cycles, and we're revisiting that level now.
I have a couple of questions here, Alexander. Going back to this sort of India versus China argument, some estimates suggest, and this is again global houses, that about 95% of money which went into China is already left China, and this is it's gone out. It was whatever hot money, whatever, but it's gone out. But that has not meant that that money's come back to India. Otherwise, markets here would have looked very different. Clearly, right? First, would you agree with that? I mean, do you have any way to measure that?
Yeah,
have you looked at the figures?
My understanding is that number may be a little bit overdone. In conversations that I've been having with large foreign institutional investors that participated in the China rally and built up exposure, they typically went from a relatively aggressive underweight stance to around benchmark. Very few have gone to an overweight position on China. Subsequent to that, they've basically held that position, maybe eroded marginally, but I certainly wouldn't think that they have fully rotated that allocation back out of China yet.
Okay. Now, is there one more source of competition for flows, and that is the US, Alexander? Because, I mean, you've got in the US, you've got a situation where it's an interplay between an economy which is seemingly picking up pace and a central bank which is willing to cut rates, right? And we can debate about the pace, but I mean, very much on the cutting path. I mean, it's a golden combination. So just your sense, what that will mean.
This is an issue that will affect all emerging markets to a greater or lesser extent. If you look historically, there is a very striking relationship between net foreign purchases of EM equities and our year-on-year performance momentum. So ultimately, the fortunes of EM equities are very much dictated by the appetite of large global crossover funds. If that money is then repatriated back towards the United States, we will feel that across all emerging markets, but some will feel it more than others. And this is where I return to the point of foreign ownership. For India, it almost acts like a moat. Having that 17.5% very low ratio of foreign ownership. And of course, what we've seen recently is the SIPs inflows here in India are breaking all-time records. The last month just went above $3 billion net inflows. That more than compensates for the FII exodus at the moment.
But US assets, in your opinion, through 25, maybe beyond, will be a big source of competition for foreign money, for global equity money. You would agree with that? Or you think, US equities themselves are too stretched? I mean, US is about 65-66% global equity market cap. I mean, can it go a lot higher? Many would say probably no. Just wanted your thoughts there.
Yeah, there are multiple indicators that we look at to call the relative fortunes of emerging versus developed markets. And unfortunately, in the last few weeks, they've begun to change for the worst. One I think that viewers are probably quite familiar with is the inverse relationship to the dollar. In fact, even in the run-up, The dollar was relatively well correlated to the betting odds of Donald Trump, and after his election victory, you've seen the dollar continue to strengthen. That is a significant headwind for emerging markets. The other thing that we have to bear in mind is that in his previous administration, he took the U.S. corporate tax rate down from 35 to 21. That gave U.S. earnings a significant boost, and the differential in earnings growth then favored the U.S. over EM. There may be a case here for history repeating itself, because Donald Trump in his campaign mentioned taking the U.S. corporate tax rate further down from 21 to 15. That incremental boost to U.S. earnings would obviously not be matched in emerging. So it's a second point, again, that would be working against our favor. So you've got that, you've got the flows, you've got the strengthening dollar, you've also got some EM indicators like new orders to inventories, earnings revisions beginning to weaken. So yes, unfortunately, I think it's going to be a far more challenging environment for emerging markets under a Trump administration than would have been under Harris.
All right, Alexander, since we're talking about earnings, the earnings here in India have been disappointing in the past quarter at least, and that's led to a pullback in the earnings estimates by roughly around 8 to around 10%, which coincides with the market correction. So earnings estimates have been cut, and the markets as well have seen a correction. But do you think there's a case for the multiple that we were getting see a bit of a cut, which could mean another down leg for our Indian markets? Earnings estimates have been cut. Do you think the multiple will get cut as well?
I think it's fair to say that we're in a bit of an air pocket now for Indian earnings. Although the forecasts at the moment are still relatively robust. I mean, for 25 and 26 calendar year, you're looking at around sort of mid-teens earnings. The consensus revisions at the moment are relatively flat. And of course, the one attractive part of analysing Indian earnings, for at least for me, is the very strong relationship with GDP. This is one of the very few emerging markets where that relationship holds true. In most economies, there's a particularly strong mismatch between GDP and earnings in terms of how the sector representation works. For India, there's a pretty good fit. And so we've worked out that there's a very tight fit if you go back over about the last 20 years on quarterly earnings versus quarterly nominal GDP deviation from trend. The R-squared is about 60%. And given our current economic projections for India, we're actually quite comfortable with the outlook for earnings. So I see this air pocket for earnings as being relatively temporary. And trying to time that might, frankly, be hostage to fortune. To your second point on valuations, you've already seen some of the overall aggregate numbers begin to soften to a somewhat more palatable level. I mean, if I was to characterize the reluctance year to date of foreign investors to engage in India, it's literally three things: valuation, valuation, valuation. That's it. And so those numbers beginning to come down a bit makes the whole story a bit more palatable. You've seen the price book multiple come down from about 4 times to 3.5. You've seen the cyclically adjusted multiple come down from 38 to 33. These are still high numbers, but India has always been expensive. But it makes it just a little bit more acceptable to start to accumulate at these levels.
Right. You're making a case for India, but at the same time, you're making a relative case for India while talking about things getting a little murkier for the emerging market space on the whole. So if you could, before we let you go, give us an absolute projection that you have in terms of return expectations from the US, from EMs, and in EMs, India and China.
Yes, I mean, I've looked at the way that I come up with an absolute return forecast for India is I map the market. If I use MSCI India, so I can do likewise comparisons across emerging markets in dollar terms. I map it against underlying explanatory variables. So I look at things like US ISM, Indian money supply growth, Indian industrial production growth, and the rupee dollar rate to project forward my absolute return forecast for India. And actually, going into next year on our current projections at the moment, we're looking at sort of low double digits upside for India in dollar terms. But that's the critical thing here is dollar terms. India has recently become a poster child of FX stability within emerging markets. And after the re-election of Donald Trump, you've seen the rupee hold firm significantly better than EM peers. So therefore, you know, on a dollar-for-dollar basis, I do believe that that's a significant advantage for this market versus others.
Right, Alexander, we'll leave it there. A great conversation this afternoon. Appreciate you joining us, and we'll touch base in 2025 again. We must, as we map out what happens for market, I mean, in terms of tariffs, trade, and of course markets there. And well, you got the index, which is down again 100+ points lower, 23,420. It's not being able to sustain, you know, sharp recoveries, but then getting sold into. We take a break. First on this edition of Closing Bell, but we've got one more conversation from the CLSA, from the sidelines of the CLSA conference. We have the head of research at CLSA Global joining us with more. Stay with us.
Welcome back. As promised, let's get straight to the conversation with Sean Cochran, the head of research at CLSA, who joins us on the show. Hi, Sean. Thanks a lot for joining in, and good to see you in. Well, we were just speaking to Alexander, who said that that tactical switch has moved back in favor of India, and that's heartening to hear. We just hope that the flows follow as well. Yep. You know, in terms of India, if you could tell us the top themes that you all are bullish on. We have seen a lot of correction, you know, on on that. Everyone was bullish on the financials and banking space, but that sector has pulled back quite a bit. There is some kind of spice building up now in the metal space as well. Which is the top theme that you all prefer?
Yeah, so for India, I think the key thing is actually what Alex was referring to earlier, which is that return of the international investor appetite is the thing that we think is going to be the most interesting, in that investors have been reluctant to chase the story. There's been local conviction that the demand is absolutely there, and as a result, I think it's the shift in the ownership over time that's going to be the major change in the way the market's trading.
So in that case, you know, from the numbers that you've seen so far, we've been talking about how there was earnings disappointment in the second quarter. Where do you see more room for upgrades from here on, and where is still possibility of a downgrade from current levels as well?
Yeah, so I think when it comes to the internal market structure of India, what we'd suggest is that the sectors that are more export-oriented and externally oriented are the ones that are going to face the greatest risk, in that there's a generalised slowdown that we see coming from global markets. And the only real upside from a global perspective would be that obviously the US is looking to provide some more fiscal support to its market, and therefore some relative resilience compared to global demand. On the domestic front, what we'd suggest is the banking sector certainly has got some challenges around the change in the interest rate environment, and when we look at local demand, we'd say the consumption sector looks relatively resilient. The other area that we have high conviction is around the consumer electronics space, where India has a niche that's breaking out in terms of its ability to deliver into global demand.
Got it. Sean, you know, are there any global themes which will play out in India as well? I mean, they always do, and much faster now, and there's much more globalized kind of a world. What's your sense? I mean, a lot of talk about renewables, a lot of large conglomerates building out renewables capacity here in India. I'm sure some are at your conference presenting as well. Let's talk about 2 or 3 themes.
Yep, so energy as a sector we're actually quite bullish on, and we think India has the right approach. And the reason is that historically, over the last several years, there's been a push away from carbon-based energies on this idea that we certainly do need to move towards renewable, and sustainability was a core theme. However, that really failed to address the affordability of that energy. And what India has done, which we absolutely agree with, is take a more realistic view in that it seeks to drive sustainability. Pushing towards solar and wind, absolutely required, but at the same time, there's still a core role for traditional carbon-based energies. And as a result, we think that India has the right strategy approach, and the world is actually coming to the Indian approach over time. And you can really see it in the way global leaders are talking about sustainability and starting to think about the implications of cost versus the delivery of that energy. If we had to pick one key theme that will change the global energy construct, it's nuclear. We see a nuclear renaissance coming, and the key catalyst for that is twofold. One is a realisation that we need to be more realistic on how do we deliver sustainable energy globally. But second, with the rise of AI, you have a whole new cohort of investors that have conviction they need a source of energy, and they're using nuclear to deliver it. When we think about that, the energy delivered from nuclear for AI can be done through new small modular reactors, and we have the whole venture capital industry in the US that's really moving on this. And the election of Trump means that we're going to see less regulation, and players like Sam Altman are championing this new move, where you have a change in the structure of how the energy sector works, insofar as we have a private buyer of this energy seeking to create private production for private means. It's a fundamental shift in the construct of demand for energy, and particularly for the ability to bring nuclear alive through what's obviously a very tough regulatory environment for obvious reasons.
And by the way, India is one of the few countries, even over the last couple of years, which is building reactors. I think we're building about 10 or 12 reactors. They're under construction here in India. So that's a global theme. I mean, and sort of find plays on that theme here in India as well. That would be the way to go.
Yeah, I mean, certainly from our perspective, our top pick is actually an American stock that is really around delivering SMRs. But you've raised exactly the key point, which is there are many economies, the poster child of this would be Germany, that has turned their back on nuclear. We've just seen that Japan has been reluctant to approve changes in nuclear, and so it's moving very slowly. We're here in India. There was never that turn away from India. They've been in the embrace of the role of nuclear as a core part of the energy construct. So we expect India to play a core role in sustaining the adoption and the acceleration of adoption of nuclear in the next decade or so.
All right, Sean, since we're talking about energy, what about solar energy? You know, over the last few years, we have seen that solar modules, solar cells as well, have seen a lot of demand. And India has been gaining actually at the cost of China, particularly with regard to policies in the United States.
Yeah.
How do you view that as a theme, the solar theme?
Yeah, so the commitment to solar will not go away, and solar is really, like many manufacturing-oriented businesses, you must continue to deliver scale to enjoy the economics or the benefits of scale through cost, and that will continue. Governments around the world are not going to turn away from solar, and India is absolutely going to continue to gain share. When you see this geopolitical shift, there's obviously an opportunity for India to step in where there might be some reluctance to buy Chinese product from a global perspective. From the solar perspective, the only challenge that solar will face is it has new competition in terms of clean energy coming from nuclear, but that will not reverse the position of global governments. It just means that the traditional carbon-based sources of energy remain crucial, but will lose share over time.
All right, final question before we let you go. Sean, going back to the sectors itself, you said that there is a downside risk to external-facing sectors in India, whereas there is an upside risk or risk of revival for the domestic sectors itself. And that's exactly the opposite of what a lot of people believe, because with Trump coming back, maybe, a stronger US could do well for some of our external-facing sectors, and domestic, which everyone's bullish on, has been facing a bit of a slowdown over the last couple of quarters. So in light of that, what are the upside and downside risks? And if you could, talk us about through some of your top picks in India.
Right. So what I'd suggest is that when we look at the US position, it's an interesting paradox in that the US has been decelerating and global demand has been decelerating, and the market is rightfully looking for the Trump administration to pick up demand in the US. However, we have to think about the timing of how this unfolds. So Trump will introduce tariffs, which is going to be difficult for growth or certainly for consumption in the US, at the same time that the tax cuts that are being looked for are going to take quite a lot of time to come through. So overall, as that process unfolds, it means there's scope for near-term disappointment in the US. You've seen the US market break out just at the same time that the Indian market is correcting. And so from a tactical perspective, it means there's scope for, as we mentioned earlier, foreign investors to buy into that, especially those that are underweight, as they start to narrow their underweight in India, at the same time that there'll be scope for profit-taking tactically in the US as we move into the new year. That's the point that I'm making in terms of the push against the consensus narrative opportunity.
All right, take that point. Always a pleasure speaking with you. Thank you so much. Have a great conference, and obviously we'll revisit this conversation with you and talk about the themes during the course of the future as well. Have a good one. Let's talk about the market itself. The Nifty is down about 74 points. Ho-hum sort of trade, not very different from what we had seen at the start of the show, but a lot of individual stocks picking up pace now. Brainbees Solutions, good numbers had come by. Stock opened with a fair amount of gain and now currently sitting with a gain of almost 7%. A lot of these stocks which had actually seen a bit of a decline are now picking up. So we have something like Suzlon, which is up 5%. Zaggle Prepaid has done extremely well. In the consumption space itself, Varun Beverages has been a growth outlier when it comes to all the companies that have reported their numbers. Now that the numbers have settled, everyone's looked at all those numbers. Varun Beverages, after that 7,500 crore QIP announcement as well, continues to find favor with investors. That stock is up around 5%. How should you position yourself in this last hour of trade? Mitesh Thakkar joins in with closing strategies. Mitesh, good afternoon.
Good afternoon, Mangalam. So, I was talking about this in the morning that it will be Bank Nifty and HDFC Bank on which all the hopes I've placed, and we haven't seen a reversal in either of them, but at least they are not falling as much. HDFC Bank, in fact, made a high of around 1719, and 1720 is my pivot on the upside. I think once it crosses that, you might see more strength. But till then, I think this is a market which still remains slightly on the weaker side. Once we see a reversal happening on the Bank Nifty or HDFC Bank, I think then we might see a pullback, right? Because day by day, hour by hour on the hourly, the 2-hourly charts, we are getting more oversold. So one of these days, we should get a strong reversal. I haven't got here long yet, but as I said, I think a reversal on HDFC Bank about 1720 or the Bank Nifty. If it starts trading above 50,400 levels again, then I think there should be some kind of a strong move on the upside. Till then, I think we'll wait on the index. But yeah, we are not shorting. In case if somebody short, we are advising to book majority of the position and trail the stop loss to very tight levels.
Got it. Okay. All right. Not advising to short, and we are due for a bounce. Hopefully that day comes soon. Mitesh, what about individual stocks? What are we looking at?
That's right, Nigel. Even on Thursday, I was waiting for a bounce back. Nothing happened, so we just went home empty-handed.
I think a couple of times, as long as you can protect your wicket, you're okay. Try to pad it up, go the Dravid way, Lakshman way, and then when you get the loose delivery, smack it out of the park. We'll wait for that day, though. Tell us the individual stocks. What are you looking at?
I was just talking to a friend of mine, and, you used the batsman analogy. I was saying that you just have to play the Bumrahs over, carefully. The rest one you can take. On this stock, I have a buy on MFSL. That's a stock which has turned positive. It's looking... showing first signs of reversal. So if it can hold above these levels of 12.25, that will be your stop loss. So with that stop loss, I think if it remains above this level, I think good chance that we'll see a rally to about levels of 1270 or thereabouts. And we'll take one short call as well, because it makes sense to have some short till we get a proper reversal. So I would suggest a short on Emphasis BFL, keep a stop at about levels of 28.10 for targets of around 2700.
That's Emphasis. And the other one was, the long call was on Max Financial. If you can pull the stock up, please.
Yes.
Just for our viewers. So 1232 is where the stock is. It's about, I think, 3% higher right now. MFSL. There you go. That's the one that Mitesh is a long on, and Emphasis is the short. Mitesh, thanks very much, and we'll speak again soon. Let's shift our focus to, of course, the space which is, the so-called accident of the day once again. That city gas distribution companies, deep cuts between 15 and 20% in some cases. Sonal is here to just revisit with what's going on here. Sonal, take it away.
Well, yes, it's a big cut that we're seeing across the city gas distribution space. It is the second month in a row that the government has gone ahead. They've cut APM gas allocation by 20% for these companies. Now, what does that mean? In terms of allocation, it has been cut to around 40 to 45% versus 70% levels that we had seen earlier. Now, APM is the domestic gas, which is the administered price mechanism, which was around 154% back in FY21. Then it came down to levels of 100%, then FY23 at 90%, and now it's at 40 to 45%. That means in their gas sourcing now, they will have to use other gases, HPHT, there is spot LNG, there is gas from new fields, which is priced at a level higher than the APM gas pricing, which is at $6.50 per MMBTU right now. That would mean the raw material prices for these companies would go higher, because now 50% of their gas sourcing will have to come in at market-linked prices, which would be higher than APM gas, which was capped at $6.50. Now, what would this mean? The companies will have to go ahead and do price hikes in order to maintain their margins. How much price hike is needed? Around 10% according to calculations. Now, that's a steep price hike. Will these companies be able to take such a steep price hike? Maybe not, because analysts believe that there are a lot of state elections which will limit their ability to increase prices going forward. This will impact their margins, and that's why this big cut that we are seeing. In fact, Jefferies goes on to say that they bake in no APM gas allocation by calendar year 2025, and that would be a big dampener. They have lowered their EPS estimates for all these three stocks by anywhere between 19 to 31%. They have cut the targets and ratings as well on Mahanagar Gas and IGL. JP Morgan has downgraded MGL and IGL. It has cut target prices on both, for MGL to 1300, for IGL to 343 rupees a share. And CLSA says that if they do not go ahead and take any price hikes, that would mean an EBITDA impact of 30 to 35% or 45% in fact in some cases. That would be a big hit definitely. And that uncertainty over policy, what happens next, is something which is leading to that pressure on the stocks today.
Okay, all right. Thanks a lot for that. So now, well, for the time being, we'll slip into a short break. You come back, we'll get some fundamental analysis going. Deepan Mehta of Lexar Equities as well as Rana Konkar of PPFAS Mutual Fund are waiting for us on the other side. Well, the bulls are not going home without a fight. Just take a look at HUL. HUL has pulled back decently from the lows of the day. So I think the intraday chart will tell you the picture. Power Grid as well, trading in the red, I remember just around 20 minutes or so ago, that as well has pulled back a little bit. And the banking stocks, some of them are cutting their losses. So you have the Nifty Bank that's up 200 points. But banks like ICICI Bank, they're cutting their losses in the last few minutes. And that's a large weight on the index. And when that happens, it obviously helps the Nifty Bank as well build on to those gains. So for the time being, the Nifty Bank continues to defend the 200 EMA, which is music to the ears of the bulls. But the stock that's getting clonked back today is Honasa. The parent of Mamaearth is down close to around 20% in the first 5 minutes itself. It was locked at lower circuit and now it's below its IPO price. Manglam has hopped over to the big wall to tell us more about it. Manglam.
Well, you know, if you look at Honasa, the key thesis of growth for the company was one, Mamaearth doing well, along with other brands leading the growth. And the second part was from online, it was going to be an offline distribution company. But this time around, seems like both those key themes have been sputtering right now. Why do I say that? Because if you look at the stock price move as well, that tells you that growth has been coming down from 45% decline from the 52-week high, a 25% decline today. The stock is below its issue price of 324 itself. Remember, similar time last year was when the issue did come by on the markets itself. If you look at the numbers, right, the revenue for the company has declined. The EBITDA has turned into a loss. And if you look at the net profit, as a result of which the company has reported a net loss as well. The company attributes that to three major reasons. The first one is disruption due to distribution model change was a little higher than what they anticipated. Secondly, slowdown in their key brand, Mamaearth, was lower than expectations at a time when overall consumer sentiment itself was weak. So what was the impact of that on the numbers? 500 crore revenue turned into 460 crores. EBITDA of 40 crore in terms of gain turned into a 31 crore loss. And the net loss of 18.5 crores compared to the profit of close to 29 crores. The other thesis of operating margin expansion because of leverage coming in terms of ad spends, that also did not play out this time around. In fact, ads as a percentage of sales went all the way up to 40%, even as the gross margins did come down. So all of that further pressurized the bottom line. What is it that did not do well for Mamaearth? Now, if you've looked at all the other brands that grew at 30%, they still account for only 30% of the company's sales. So Mamaearth, which is 70% of their overall mix, had to perform. This time around, the companies said that there has been a wave of preference towards active-based ingredients itself. So if you speak to some of your friends or people who buy beauty products, you would hear words like hyaluronic acid, niacinamide, peptide, etc. So this underlying macro trend has impacted the wave of naturals. Secondly, the company hasn't allocated enough investment for offline-based brands. And third, they need to rethink their strategy when it comes to product, price, and communication on the mother brand. Cut to the distribution model itself. How long before that fixes? Well, the management believes offtake scale-up of new distributors could take up to 2 to 3 more quarters. So with all of this, twin engines not firing right now, the onus is on the company to go ahead and revive at least one of them before the street looks at Mamaearth freshly, because it was always trading at a premium because of its outperformance of growth versus the industry, and that hasn't come by in this quarter.
All right, Mangalam, thank you very much. So, a lot of stuff up in the air now in terms of direction, strategy, etc. as well, as far as the communication from the founder, the management is concerned. Deepan Mehta of Elixir Equities is with us. Ronak Onkar is also with us, the co-fund manager, equity, head of research at PPFAS Mutual Fund. Gentlemen, good afternoon. Good to have both of you here. Thanks very much, and apologies. I think we're hitting you late. Deepan, first up, what do you make of Honasa, Mamaearth? As a business, what does one do from here? And second, I think the broader, bigger lesson, right, which I think you and others have also always said, IPOs, give it a couple of quarters at least, maybe a couple of years before you start to actually, buy into these. So just your thoughts on what we've seen today, 20% down.
Yeah, Prashant, good afternoon, and thank you for having me on your show. I think that time and again, this strategy has proved to be very profitable. You just avoid the IPOs and wait for 1 or 2 years, then see how the stock is trading. You may get it at an attractive valuation. In the case of Honasa, what attracted everybody to the stock was that it was a category within the FMCG space which was underpenetrated, and here was a company which was growing exceptionally well. And you always want to have some allocation in your portfolio to an FMCG stock. And considering that all the peer group stocks like HUL, Nestle, Godrej, all of these companies are growing at low single digit, here was a stock idea which was showing very decent growth. But now I think that thesis also has been tested. I think I would just wait for 2-3 more quarters. Stock price may have a further decline to take place, and let the operation stabilize, let the company start to report higher volume and profit growth. Then one could look at it afresh, but for the time being, it's a complete avoid.
Okay, got that, Deepan. Well, let's get in Ronak Onkar as well into the conversation. He is the co-fund manager, equity and head of research at PPFAS Mutual Fund. Ronak, I've been waiting to speak to you actually. What are the cash levels? You're one of the few guys out there who had 15% plus cash levels. I think it was drifting towards 20%. Markets are down closer on 11%. That's the headline index. But stocks have corrected substantially. Have you all started deploying money now?
Good afternoon. Thanks for having me. So I think you guys predicted last month that the cash levels would go up by 5% more, and it definitely happened. We are at 20% cash as of October end fact sheet. But we have been deploying slowly and steadily in the stocks we already like. Something like private sector banks, a bit of IT, a bit of ITC, Power Grid, Coal India. Some of these stocks we've been adding, but nothing new in the overall scheme of things we have found, which is extremely cheap. Like you said, stocks have fallen a lot, but they have fallen from their peaks, and that doesn't necessarily mean the valuations are still reasonable. So we'll wait it out till we find good opportunities.
So the top additions that you all did, if I got that correct, was Coal India, the large private sector banks. Is that correct?
Yeah,
Infosys?
some of the usual suspects we have been adding for the past several months.
All right, and that would include Infosys as well.
Yeah, a little bit of IT also we've added here and there.
Can you explain your, fascination with ITC this time around? Because yes, obviously in the consumer space, it is a value bet. But if you look at some of their metrics, volume growth has been lacking. Say the other peer, Godfrey Phillips, by a while over the last 7-8 quarters. FMCG business is hitting a bit of an air pocket right now. And hotels, everyone says that maybe, the cycle is on the way up, somewhere closer to the top. So at these levels, why would you buy ITC more and more?
So interestingly, the metrics that we were looking at when we started buying ITC were the FMCG business and the profitability contribution to the overall P&L. That has been improving over a period of time. So some of the trends that we were expecting that the company will deliver, they have been delivering. On the other hand, the capital allocation is now more clear to make sure that cyclicality of the hotels business is also in their favor. Some of these things have worked in their favor, but that does not mean necessarily valuations have become very, very expensive. So even within the consumer space, I think for the growth that they deliver, the valuations are still reasonable. And that's the reason we have added a little bit over our existing position.
What about the capital market plays, Ronak? The last few conversations I've had, you have saying that you're lightening positions. I'm just looking at the sheet that I have with me, and it appears you'll have lightened positions even more. And even I think ICRA is something, after a while, I'm seeing that you'll have, lightened positions out there. Tell us more about this. You think the best has played out for this capital market related plays?
I think we have had too sharp upturn in terms of volumes in the market and profitability for the companies, and cyclicality bears the fact that this gravity will definitely pull the volumes and volume growth down over a period of time. So we don't want to catch the falling knife. So whenever we see valuations becoming too unattractive or too much out of favor, we start trimming. And we've been trimming these from that point of view.
Since we're talking specifics, Ronak, Reliance, any thoughts? And the other one I wanted to ask is Indigo. We had the Indigo new CEO with us at our event on Thursday. They're talking about, doubling the business over the next couple of years. Just your thoughts on these two?
We don't own these stocks, so don't want to comment about individual companies we don't own. But interesting companies, we always track them.
Okay. Deepan, same question to you. Reliance and Indigo?
Yeah, first to disclose that we are invested in Indigo and very positive on that business. I think attractively valued given its position in the industry. And there have been certain short-term challenges in terms of a lot of planes being grounded, and that has increased the cost of operation. But I think that should gradually ease, and with lower oil prices and also travels, kind of holding up the traffic as such. So I think the prospects are pretty good, but you should expect a lot of volatility in the earnings as far as Indigo is concerned. And Reliance, I think we need triggers. I've said time and again how they are going to unlock the value in the retail and the Reliance Jio business. That's the key question. Is it going to become a holding company, or are they going to split the company? I think that will determine the future for Reliance Industries. And a split may easily entail a 10-15% up move, but a pure IPO with Reliance becoming a holding company means a lot more disappointment for Reliance shareholders, and this underperformance will continue for some more time as well then.
I just want to highlight two names in the solar space. Vari Energy is popped up to the high point of the day. It's up 7%, 8% now. And Premier Energies is up 12%. And by the way, they are the number 2 and number 3 largest volume-led gainers right now. Humongous volumes on both these names. with 8 and 12% gains coming through.
All right, we'll keep an eye out on that. Dipan, I'll come back to you with this question, but first to Ronak. Ronak, do you think HUL has everything priced in already when it comes to the slowdown in the consumer sector? And from here on, with the weakness that we're seeing in some of the other players like Mamaearth, etc., it's likely to get better from here on? I mean, we heard, again, at the Global Leadership Summit from the Global Growth Officer of Unilever, SE, and also Rohit Java, who said that, going forward, maybe the building blocks that they're putting in place would be better for Hindustan Unilever.
So again, we don't own this stock, so don't want to comment too specifically, but consumer goods companies are extremely competitive in nature. Even if you see the larger ones and even D2C brands coming up and the ease of access to market now in terms of having the entire platforms ready to just launch your product, I think some of these things will definitely be challenging unless the existing brands, the incumbent brands also use these techniques to reach out to the younger audiences over a period of time. So I think it's a long-term question where we have been tracking these companies for a long time. We love the cash flow profile, but haven't been buying them because the valuations have always been so attractive, so unattractive and unreasonable for us. So we thought only one or two plays in consumer made sense to us. That's why we own only one ITC.
I don't know about Prashant and Nigel, but I've been reading a lot about hyaluronic acid, niacinamide and peptide and all those, ingredient-based products, which HUL is also coming by. They've admitted that they missed the naturals wave, but they don't want to miss out on this active ingredients base right now. So their beauty and personal care, they've, also segregated the segments. It's beauty and wellness and home and personal care right now. So with active focus on that, it will be very interesting to see if this category, which is growing extremely fast, grows faster for
By the way, all those names sound like a chemistry class. And that was...
all you have to do is go into the dressing room of maybe your wife or your daughter. You will find all these names at the rack. There are sunscreens which have SPFs, peptides, etc., moisturizers which have hyaluronic acid.
Mangalam said you go into the dressing room and he stopped.
I
was thinking Prashant is in the spot. But anyway, let's get on to the metal stocks. But before we do that, Ronak, you all have played a couple of these special situations. Namely NMDC, if I remember correctly, you all had played it very, very early on. You all played NMDC Steel, NMDC Limited. And I'm looking, as per your last disclosure, I think you'll have completely exited NMDC Limited as well. It's been a very, very good run for y'all in this special situation. Any other special situation that, we should be looking at that y'all are currently playing?
Nothing at the scale at which NMDC was there. And it was an interesting opportunity. And the whole idea behind playing these cyclicals this way is that your downside risks are limited, but the upside is unknown. So we took the chance when the NMDC got demerged. But yeah, you will see it in the fact sheet if any new situations come up and we participate in them.
All right, Ronak, thanks a lot for joining in and giving us your take on how you'll have placed. And thanks a lot, Dipan, as well for joining in today. For the time being, we'll slip in a short break. You come back, we'll get you some buy and sell calls for a reverse trade in the next couple of days.
100th year of India's independence, we would see a well-developed India, which all of us can be proud of, and which our younger generations deserve, because India's aspirations have, if anything, progressed and progressed steadily, but I would think a bit slowly. So there's reason for us to contemplate as to how we can make this aspiration, a generational aspiration, a reality. So in that context, there are a few things that I'd like to share with you all on how we see from the government's point of view on what are the kind of things that we can do, and how are we, from the government again, hoping to build this path so that it becomes easy for all of us to work together and achieve what is an aspiration today, but as a reality by 2047. I'll only repeat some of the fundamental facts which all of us are quite familiar with, but more to set a tone and background for what I want to share with you. 2013-14, we saw India in the 10th position, 10th largest economy. Post that, we grew rapidly, and by 21-22, we've reached the 5th position. Hopefully, in the next few years, we will be reaching the 3rd position. And banks, of course, play a very crucial role in helping the country move forward, and not in the usual pace. We have to move forward comprehensively, touching every sector of our economy so that we can achieve the goal that we are hoping to reach. It's important also equally to recognize, as the chairman himself said, CMD himself said, that Indian banks have recovered and recovered to give a message to the world that it is possible if only professionalism and high moral ethics are maintained in our banking structure, that even if we were in very distressed situation, the twin balance sheet problem has been referred to by Mr. Sethi. From that, in a very systematic fashion, with the policy of the government, banks were able to come out, companies were able to come out, the economy started feeling the relief of the stress being taken out of the banks. And they...
All right, interesting commentary coming in from the Finance Minister at the SBI Economics and Banking Conclave. Of course, our colleagues are listening into it and will alert us for any important developments or any important insight that comes in from the Honorable Finance Minister itself. Meanwhile, for the markets, 60-point downtick, mid-cap index holding mildly in the green. The Nifty Bank has done extremely well with a gain of almost 250-odd points. So good time to get in the tomorrow trade from Mitesh. Mitesh, would you fancy your chances taking a long trade today for a sellout trade tomorrow?
See, again, as I said, we haven't got a sign of reversal as yet. I think the bank Nifty is picking up again. So there's a positive sign. So on stock specific basis, yes, the index we haven't, still started going long. Though as I advise, I think, we already suggested people to cut their short exposure and wait for some kind of a reversal sign of pivot to be crossed on the upside. So I think we'll take the stock route. PEL is a BTST for me with a stop at about 1040. Look for a target of 1065, 1068 for tomorrow. And the other one is Hero Motors. It had a positive news flow. It opened with a gap up, has come down, but is now at the intraday moving average support areas. So Hero Motors is a BTST. Keep a stop at about levels of 47 and 30, or maybe 47.28, and look for a target of around 47.75 to about 47.80.
Mitesh said time to cut some shots. I think the bulls will be happy to hear that. It's like it's a turning wicket, and the Australians only had Warner on one side. So if you played him out, the other end could get a little bit easier, provided Tim May was not playing. So it appears we're getting to that stage where the other end, at least there'll be some loose deliveries, and maybe the bulls can make a bit of a comeback. Got that, Mitesh. Thanks a lot for that. Well, time to slip in a short break. You come back, we'll wind down the markets. Last 10 minutes coming up for you. Welcome back. Oracle Financial is a stock that slipped in the last few minutes. It's moved to the low point of the day, so keep an eye out on that one. On the flip side, though, from the broader markets, you've seen quite a few stocks that are bumped up. Infra has been doing well. There's a bit of a shortage we've been mentioning with regard to chrome ore globally, so that's one stock that is benefiting out of that. Avalon Tech, it's been one of the big winners. I remember post its results, it did well. Today, it's building on to those gains as well. And Godrej Industries as well. That's another stock that's moved up. I think, Mangalam, you briefly mentioned Varun Beverages.
Yeah.
That one as well, it was up already, I think, 2-3% odd. That as well has seen a bit of spurt. So the headline index is under pressure, but stocks doing a thing of their own.
Absolutely. And, you look at Kalyan Jewellers as well. That stock was up around 2.5% as well. Most of the spike coming in just the last few minutes. Stovecraft is doing well. Cross, KROSS, recent listing up around 16%. And a space that you track very closely, Nigel, the cement space, we have JK Lakshmi, which has suddenly spiked. It's off 6% from the lows, currently to the high point of trade for that stock as well. And this morning we had some commentary coming in from, the market experts saying that they're still backing some of these capital market plays. Look at BSE, big move is what we're seeing on BSE, currently at the high point of trade for that counter as well. So a bunch of broader market stocks doing extremely well, telling you that portfolios might not be feeling very bad after all.
All right, let's get in Anand Tandon. Hi Anand, good afternoon, good to see you, Ben. Give us a couple of stock ideas then that you'll be looking to buy. We have seen a bit of a correction. You have been sounding cautious the last few interactions we have had as well. Any of those stocks that you would prefer at current levels?
Well, I think there is still, I would wait to see correction turning around before you start to buy. I think there is potential for further downside from where we are. While the indices have fallen and some of the stocks have reacted, but don't forget, most of them have actually doubled over the last 2-3 years, if not in shorter periods. So it's not as if a 10% correction or a 15% correction accommodates the valuation. That said, the only sectors that kind of look attractive remain the same, the ones that have not moved so far, especially banking, private sector banks, and so on.
All right. So in banking, are you backing the private sector banks? Are you looking at also some of the NBFCs, or you want to stay away from that given the stress that everyone's talking about in the microfinance lending space?
Well, NBFCs are not my favorite. The basic issue remains even today the fact that your deposit growth still has to be larger. And NBFCs are not well positioned for that. They don't have a liability profile. On the asset side, if you look at it, even the secured book is beginning to look a bit iffy in terms of the retail side of it. And the industrial side is not showing a great pickup, though some of the numbers are beginning to look better. So NBFCs don't participate on that. They are largely on the consumer side. And both the secured and unsecured book on the consumer side is not particularly in the pinkest of health. So no, I think liability is what I would be looking for. Banks are best positioned.
What do you make of the Honasa situation, Anand? Have you given it any thought?
Well, just think about it. HLL is not run by fools, right? So if there was one category which was really large and which could do very well and could give you the kind of growth, why would they not go into it? And it's not only Unilever, right? It is almost all the other players. So yes, there is somebody who can grow very quickly, in one niche for some time. Can it continue forever like that? That is a question that I've always, had. And the answer is clearly now visible in terms of the performance. So, whether you attribute it to distribution or whatever else, the reality is that finally there are only a few segments which are going to be able to show that kind of stupendous growth, and that too for short periods. Otherwise, it's not going to last. So valuations has to correct to a sensible level. Expectations in terms of earnings and top line has to correct. And only after that, some of these companies can be attractive as investments. As companies, there is no doubt they have done a good job. They've come up from nowhere and established a reasonably large portfolio within a fairly short period of time. So kudos to the entrepreneurs. But as investors, you need to be toning down expectations very sharply.
What about the recent listing, Swiggy? Zomato, there was plenty of interest. Swiggy seems to have priced it correctly. The stock made a high of 490, I think, the next day after listing. And now it's at around 425 or thereabouts. So it's come off considerably from today's low. Your view on it? Because the industry clearly has a lot of tailwinds. We're getting lazier, so we'll use their services. So good for us. But is it good for shareholders as well?
So, again, think about it. You can use their services, and for the moment, they are, able to grow into new areas. But as you move out of the larger cities, the number of people who are willing to pay a premium for delivery is not going to be high. So the numbers there will have to slow down, costs will go up. Even here, even in the major cities, you may not feel the pinch when you're paying 15 rupees a pop. But if you were to try and increase that, you will find that there is going to be a lot of resistance. Already you find that Swiggy partners, for example, are expecting to be tipped. That's not a culture in India that we don't necessarily tip everybody who comes. You expect the companies to pay for their services, and you are being charged whatever the company thinks is required to be charged. So unless there is a dramatic change, and that may be possible, but I think habits take a long time to change. I think you would again expect to see some slowdown coming through. It may happen that you're not particularly careful right now about the usage of capital, but overall, I think these are all services which will slow down fairly slowly. Right now, it is attractive only because the next in line, the bigger brother is priced at humongous levels. So therefore, it looks relatively cheap. So on a relative basis, yes, but on an absolute basis, I still have my reservations.
All right, take that point. You whetted our appetite with, a commentary on the beauty and wellness market, along with the food market as well. Last, we'll have to keep our conversation a little brief right now because we're running into market close. Always a pleasure speaking with you, Anand. And speaking about the market close itself, it's been a volatile day, but to sum it up in a line, it would be down but not out. The Nifty is down 70 points, but it's seen a formidable recovery from the lows. The Nifty Bank was, the one that batted for the bulls along with the metal stocks, and a lot of these, stocks which came off the lows as well. Case in point, some of the IT stocks and even the FMCG stocks towards the end of trade, where you had HUL, Nestle, and a couple of these earlier PSU banks like SBI, etc., doing extremely well. On the way down, though, we did have IT stocks which saw a cut of almost 3.5%.
Okay, well, I think IT services and oil and gas are the two areas which saw a maximum amount of selling pressure. And metals, of course, on the other side of the equation, with gains actually holding on Hindalco, Nalco, Tata Steel, and more. Maybe just one or two, a few other names before I wrap it up. Vari and Premier Energy were the two new energy listings recently, and both end with gains of over 10% each. That's very strong. There was First Cry and KR, and actually big volumes on many of these newly listed companies. KR and heat exchangers, First Cry were some of the other big gainers today. We, of course, have been highlighting what happened with Muthoot Finance. So that goes home with about a 7% gain. And, of course, Nigel has been talking about Nalco with its very strong gains as well. So not a bad session, actually, by the end of it, with just about a 60-70 odd point cut. Was looking much worse at one point. The low today, by the way, has been made at 23,350, and we end about 100 points off the day's lowest level at 23,465. So that is the sort of picture. Nifty Bank ends higher, mid-cap index ends slightly higher, the small-cap index ends slightly lower. So more flat, especially when you compare the days that we've had over the last many trading sessions now. What we'll do is we'll say goodbye here and thank you for staying with us. But we bring you our conversation with Chris Wood from the sidelines of the Global Leadership Summit.